Hello, welcome to the market wrap-up. The market ended the week on a positive note. Nifty 50 was up 0.92% while Sensex was up 0.88% for the week gone by. Nifty is still down 5% month to date while it is down 15% from its October 2021 peak. The buying in the index was broad-based except for IT sector which remained under pressure after earnings downgrade reported by global peers like Accenture. The relief rally during the week was led majorly by automobile and auto ancillary stocks, which saw investor interest on back of easing steel prices and positive macro trends. The Indian automobile sector in the last 1 month has outperformed the broader market indices, which has come as a welcoming relief for investors. The outperformance was led by improving volume offtake and improving ability to pass on the recent price hikes by OEMs. The underperformance was on account of several headwinds in form of raw material price inflation, supply chain issues, and rising fuel prices. Investors are sensing an opportunity in auto because metal prices have been falling while there are signs of demand firming up in the passenger vehicle sector. The demand for two-wheelers had been impacted due to weak rural demand. After declining 36% between FY19 and FY22, domestic two-wheeler sales are finally consolidated. Two-wheelers are expected to gain momentum as rural economy opens up, which can be seen in the sequential improvement in volume numbers for two-wheeler OEM as offices and schools in all geographies are starting to open up. Surging replacement demand in all segments will also be a key driver for the industry. CVs are expected to benefit from strong pent-up replacement demand in addition to the improving infrastructure and construction services as well as improvement in freight availability along with increasing demand for e-commerce and last mile delivery, which should support the CV volumes for foreseeable future. The pandemic has created an excellent opportunity for expansion in Tier 2 and Tier 3 cities, particularly in the LCV category, which earlier relied on metro cities as their big volume drivers. The rising cost of fuel and the need for clean energy has also created a marketplace for electrification of vehicles in all segments of the industry. This has led to more and more OEMs spending capex towards setting up of EV infrastructure, which could in turn help improve the demand for EVs. We see this as the next major disruption for the industry. Passenger vehicles, which have been seeing demand tailwinds for past several quarters, are expected to surpass their FY19 peak volumes of 3.3 million units on back of easing chip supply shortage as OEMs are finding new suppliers and supply chain issues are easing out. The PV manufacturers are also sitting on strong order books. For example, Maruti has been sitting on a strong open order book of 350,000 units, while M&M has been sitting on an order book of around 178,000 units for its four new models, while Tata Motors has a strong order book of 150,000 units, mainly consisting of EVs. The surge in utility vehicle segment sale volumes, despite higher prices and higher waiting period, also indicate an ongoing theme of premiumization in the passenger vehicle segment, especially in the urban markets, with preference given for premium features, design, and comfort. Confident of having hit a strong demand upcycle, vehicle manufacturer and their component partners are planning to spend more on new capacities, new products, and new technologies in the coming year. For example, new factories have already been set up by Maruti Suzuki, Tata Motors, and M&M, and there have been an expansion of output at current factories of tire makers like JK Tyres and Ceat. Tata Motors also recently bought Ford India's Gujarat plant to take on the readymade infrastructure on board. Capacity increase by vehicle makers concurrently will lead to a similar increase by their auto part supplying partners, which will in turn also benefit the auto ancillary industry. In our opinion, during these volatile times in the market, Investors need to revisit basics of investing and revisit sectors where there is an opportunity for long-term wealth creation. Fundamentally strong sectors like automobile and auto ancillaries, in our opinion, are seeing multi-growth tailwinds and could be looked to include as a part of our portfolios to have a chance of maximizing returns. A combination of increasing growth and improving gross margin should aid the earnings upgrade in the sector in the coming quarters with improvement in valuation multiples which are currently at the lower end of their valuation bands. Thank you.